Hey everybody, welcome to this free edition of our Trading Use Group, a weekly roundup for the trading week ending on March 11, 2022. I'm Preston Brent. Thanks for tuning in. Well, the theme this week is going to be tornado warnings because I think we've got an unsettled market coming up over the next 4 weeks, but more on that in just 1 minute. What I want to get into is just kind of where we've been and what we're setting the stage for here. So if we just take a look at the index performance for this past week, you can see everything was solidly in the red. Year to date, everybody's solidly in the red. Year to date, we are in correction territory out of every index in the US with the exception of the Dow. However, from the all-time highs, we're clearly, in fact, with the Nasdaq, we reached bear market territory. Okay. I mean, this week was extremely volatile. As seems like day to day, we're guided by any news coming out of the Russian invasion in Ukraine. Nasdaq actually fell to a bear market just briefly earlier this past week, down about 22%. And at the low point this week, the S&P was down about 14%. So we're still in correction territory, as I said. We're getting this surge in commodity prices, and it's really mostly visible to the consumer in gas prices at the pump. And we're going to start to see food prices go through the roof as well. In fact, the latest U.S. GDP now forecast out of the Atlanta Fed is showing Q1 GDP coming in at 50 basis points. Now, granted, there are other estimates I've seen as high as 4 or 5% for Q1 GDP. So even assuming we fall inside that range, markets or GDP and global growth is slowing down. And we've got inflation possibly running anywhere from 8 to 9% range for a while. So we've just got a lot of turmoil coming up. Okay. And I just don't think we're going to get the Feds riding to our rescue if price action falls 25 to 30% down, because the Feds are going to be backed in the corner. They're going to have to jack the rates as well. Okay. You can see in the upper right hand corner the PE ratio. The forward PE is now down below 19, about 18.85 right now at market close on Friday. I still believe it has a little bit further to go down, probably in the low 18s, high 17s. Dividend yield for the S&P is sitting at 1.44 at Friday's close. 10-year Treasury about 2%. So the 10-year Treasury is about 56 bips higher. That's a little over a 0.5% higher than the dividend yield. Although the earnings yield for the S&P closed out the week at about 4.89%. So that's about 2.89% higher than the 10-year Treasury. So there's still asset allocation and rotation going on in the U.S. equity markets with those companies that pay very little or no dividend and have poor cash flow, and you're buying on future earnings. Typically, you'll see that in software companies, tech companies, things like that. They're just getting crushed. A few of the higher performing tech are holding up a little bit better, but basically that's kind of what we're seeing. We've got the real yield at a negative 5.01%. So that just means inflation coming in at 7.9, which was market expectation. Still very high. All right. Weekly jobless claims this past week came in slightly above expectations at 227,000. All right. But keep in mind, inflation, as I said, came in at 7.9% over the past 12 months. Now, that's the most since 1982. Now, understand, the way they calculate U.S. inflation is a little bit misleading. They don't include food and energy under the idea that those two are very volatile, but that still does not negate the fact that consumers need to put gas in their cars, most consumers, and they need to put food on the table, every consumer. So that's going to affect consumer spending. In fact, this weekend's Barron came out with what they call the basics CPI, or they call it the Barron's basics CPI. So they include in there things like foods, like meat, eggs, bread, milk, produce, things like that. They, in addition to gas, utilities, shelter, all of these things. And by their calculations, Barron's is saying inflation year over year is 16%. That to me is a more believable number. That's going to force consumers to start watching what comes out of their pocketbook. Now, keep in mind the U.S. GDP, 70% of it is consumer spending. And granted, the consumers have been bottled up for a couple of years with COVID, and they're really anxious to get out and spend. But with higher rents, higher gas, higher food, that's going to curtail that. Okay, so hence we're going to see slowing growth during this regime change in the market environment of rising interest rates. All right, so just expect that. And by the way, that 16% doesn't even include this huge expansion of agricultural products like wheat and corn and grain, since a quarter of the world's exports have pretty much been taken offline. So that's going to just exacerbate inflation even more. Okay. And the other thing that I wanted to call out is the S Treasury yields, right? The spread between the 2 and the 10-year, which is affectionately called the yield curve, has reached its tightest level since March of 2020, right? March 23rd of 2020 was the lows during COVID. And just understand that when the yield curve moves below zero, it's also considered an indicator, but not completely infallible, of a coming recession anywhere from 6 to 9 months out to a year and a half from a negative print. Now, we're getting some TV pundits talking about a recession the end of this year. Understand what a recession is. That's 2 back-to-back quarters of negative GDP growth. I do believe this year we will have negative corporate earnings growth, and I do believe that the markets are setting up for a possible stagflationary type of environment. And that's kind of like the worst of both worlds. That's where you have rising prices, rising inflation, but there is no growth to help consumers out. And whatever wage gains you get, it's going to be eaten away by inflation. So that's going to be really ugly, right? And of course, if we come over and we take a look at, we just talked about economic data. If we come over and look at Europe, you can see Europe, because they were down. Yet last week, Europe week to date, the prior Friday was ugly, over a correction in just 1 week, 10% down, 8%, 12% down in a week. Well, this is more of a dead cat bounce from that down week. You can see year to date, just about all of them are in correction territory. The FTSE's only down 3.1%. And then you can see over in Europe, the inflation expectations strengthened. The ECB kind of surprised markets this past week with the announcement that it could wind up as bond buying sooner rather than later. The UK also jumped into the game of they're going to stop importing Russian oil and gas by the end of 2022. Kind of what the US did. Sippy Cup Joe announced that this past week. So we got the European Union. However, they've kind of unveiled a plan to cut Russian gas imports by 2/3 within a year. Can't wait to see how they're going to do that. They kind of built their own bunker tied into Russia, which was a big strategic mistake. But, politicians are not the smartest people on the planet. So, and not the most strategic thinking on the planet either. They only care about getting reelected. So, we'll see how they get themselves out of that one. Okay. And then, of course, if we go over to the Asian markets, you can see everybody is in the red this week. Year to date, everybody's, not doing that well. Japan, their CPI data remains pretty much muted. Their country's PPI data rose about 9.3% in February. All right. That's the steepest gain they've had on record. But that's generally driven by higher energy prices. All right. So there is some anomalies in some of their data. Their economic growth for Q4 of 2021, right, was downgraded to an annualized 4.6 from a 5.4. That's a big drop in their GDP growth. So they're slowing down. And of course, if we look at the Chinese markets, they're ugly as well, right? Believe it or not, they had an ugly week this week. You can see they were down 4%, Hang Seng down 6.1% for the week. Now, that's a weak number. Primarily because they're starting to shut down because they're seeing a resurgence, surprise, in COVID. All right, who knows what's going to happen there. But the other thing, they've got a week-long annual gathering of National People's Congress, and it's so like a communist country to put the word people in the name of their government entity, because people have nothing to do with it. They screw the people. It's mostly the high-end politicians that make the money. It's like the People's Bank of China. The people have nothing to do with the Bank of China, but they call it the People's Bank. So the National People's Congress, it's just a week-long annual gathering of the head muckety-mucks of the CCP, the Communist Party, Chinese Communist Party, right? So they're meeting, they set a goal for their GDP for the next year of about 5.5%. All right. That's the lowest setting they've done, sub 6%, I think, in what, 30 or 40 years, several decades anyway. Their PPI rose to 8.8% in February from a year earlier. But basically, their economy is not in good shape. In fact, Japan and China are the only central banks talking about easing and putting more stimulus in the economy rather than out of the economy. So that's just kind of a back of the napkin view of kind of what's going on. If we look at the charts, let me just swing over. We'll stay in the U.S. here because that's pretty much where most people invest here. Even Europeans, Asians, and so forth, pretty much invest in U.S. markets. It's the big market of choice. I'll wait for it to come up on the screen, but what you're going to see first off is the S&P E-mini futures. You'll see that really wide range for the week. I mean, where this chart looks just like a bear chart, as I've been telling you. You can see the 50 EMA, that red line, and the 200 EMA, the yellow line, both have downward vectors. Obviously, the 50 EMA has a steeper slope down than the 200. But at this rate, it suggests they're going to cross sometime out here in another week or two. And you can see the range. If I were to blow it up, you can see that huge range that we had on Friday. I mean, the markets were up at one point during the day on Friday before the markets opened at 43.26. It closed near a low at roughly 41.96. Folks, that's a huge move, over 130 some odd points intraday from the highs to the lows. Sellers were just coming in and just attacking this big time. And as I said earlier, we get the FOMC with Boom Boom Powell Friday press conference, U.S. policy statement. They're pretty much on record saying they're going to cut the rates by 25 basis points. They're going to meet 7 more times before the end of this year. Some financial pundits believe every meeting is a live meeting where they hike the rates 25 basis points. I don't think they're going to be able to get there. I personally think they're going to stop at 3 or 4 this year and then take a long pause. But inflation is going to stay higher for longer than people think. Okay. You can see right now, we're going to, now, what I believe, and this is what I've been telling our members, I said we're in for a short-term minor bounce. And I was expecting to bounce a little bit higher, but I'm also saying through the middle of April, we're going to take out these 2022 lows of 41.0175. We're going to take them out, and we're probably going to come close to a bear market, although I don't think we will. I'm calling for a range on the high end side of 4,100 and on the low end side of around 3,800 over the next 4 weeks. And of course, the big shaker and mover will be next Wednesday's FOMC policy statement at 2 p.m. Eastern Standard Time. And then at 2:30 p.m. Eastern Standard Time, we get Boom Boom Powell's press conference. For those of you that honor daylight savings time, understand for the U.S. markets and many other markets, this Saturday evening, tonight at 2 a.m., you need to turn your clocks forward 1 hour because daylight savings time kicks off officially at that time. Okay, so that's where we're looking at for the S&P. Now, of course, if we come over here and look at the Dow, the chart's going to look the same, guys. It's a bear chart. In fact, with the Dow, we had a cross in the 50 and the 200. Now, one thing I want to point out on the E-minis, and then I'll point it out on the Dow as well. Another reason why I'm saying we may have put the highs in for the year. The all-time highs were made in the S&P on January 4th of this year. Okay, it's one of the last to hit the all-time highs. And if we look at the Dow, the all-time high where the Dow was made on January 5th. Okay, and you can see the cross now in the 50 and the 200. So all-time highs for both the Dow and the S&P, January 4th and January 5th, respectively. We're going to come down and take out the 32,167, and we're going to go much lower in the Dow as well. Okay, and the other thing that I want to show you is now let's look at Nasdaq. If we look at Nasdaq, you're going to see here that we've already crossed. So the Dow index, the 50 and the 200 is crossed. The Nasdaq index, it crossed March 1st. All right. Now remember, this is 100 of the largest companies in Nasdaq. but the Nasdaq composite index is almost exactly the same as this. And we're coming down here. This is a bear chart, folks. Even though right now, officially, we're not quite in a bear market, we're pretty darn close. Just a couple of points lower, and we're back in a bear market for Nasdaq. Okay. And a lot of the selling has taken place in Nasdaq because mostly high growth, high beta tech companies. We would expect that. So this is a bear market chart. I do believe any rally should be sold, as I've told our members, and we're going to make new lows in Nasdaq. And then, of course, if we look at the Russell. Oh, by the way, with Nasdaq, one other thing I forgot to show you here. If we look at Nasdaq, the last all-time high in Nasdaq was made last year on November 22nd. Okay. So if we look at the Russell, and we'll start, when was the last all-time high made in the Russell? You can see here that the RUT all-time high was made on November the 8th. So the first index to roll was the Russell on November the 8th. Second index to roll was Nasdaq. Third index and the fourth index, roughly within a day of each other, was the S&P and the Dow. Folks, that's classic end of bull market, start to begin the auspices of a regime change to a bear market as rates start rising. Okay. So that's kind of what we're seeing here on this. And let me just get that off. I think that's let's get that off the screen there. So if we look at this, you can see just where we're sitting right now. And you can see the low that was made here on this at 1883. I've got it marked right here. We had a death cross back here in early January, back when the Dow and the S&P were making all-time highs. The Russell was doing a 5,200 death cross. Again, classic bear market. We were down on February 24th. We were down 23.48%. All right. So we're going to take these lows out as well. But because the Russell tends to lead the markets into a bear market, or tend to lead the markets out of a bear market into a bull market, it's the first one to move, right? So we're getting heads up here that it's going to get a little bit uglier over the next couple of months. I do believe we will get a bounce sometime mid-April, third week in April or so. The bounce may last for a week or two, and then we're going to roll back down. Are we going to stay in a permanent bear market this year? I don't think so, but I do believe our highs for the year have been made, right? And our all-time highs for this year have been made. We got to now understand we've got wide tail risk in the markets. What does that mean? That means that the markets can move lower faster than you think, or higher faster than you think. And that tail risk, both upside and downside tail risk, is caused by the war in Ukraine. Any bit of news on a negotiated settlement, and boom, you will see that they are going to reward the markets. But that would be an opportunity for you to let it run for a day or two and then sell into that rally. That's what we're going to do. Okay. If we look at the stocks here in the FANG index, it's even uglier because now this is the best of the tech. This is the best of breed tech. And as you can see, I got to adjust it down. We made a new 2022 low back here on the 8th of March this week. And you can see we've had the cross in the 50 and the 200. Now, these are the best of the best of the tech, right? So that would be Microsoft. Facebook's already been crushed. Apple, Netflix, Google, and Amazon. Amazon just came out with their big 21 matching Google's stock split, reverse split. That tends to be bullish for the stock. Apple is holding up fairly well, although they're all down very strong. But these would be buying opportunities for the long-term trader. For swing traders, any rally, just sell into that rally short-term. All right, that's kind of how I'm looking at it. The other thing you want to do is you want to look at transports, all right, because transports tends to help lead the market. You can see the all-time high in transports were made in 2021. All right. So just like the Russell and the transports are getting ready to cross the 50 and the 200, right? And you can see where we're sitting here on the transport. So again, all signs point to lower price action and any rally will be sold. So just understand that's kind of where we're sitting right now. And if we look at Bitcoin, it is correlated to the equity markets, folks. It is not a fear gauge, not like gold. And Bitcoin, you can see the 2022 low was made back over here in late January, but it was down 52.63% from just November the 10th to January 24th. It gave up all that price. All right, that was a huge move. So that's why we're going to chop around here for a while, probably build steam for a longer term run, but now's not the time for that run. Okay. And of course, as I told you about volatility, let's just get this set here like this. If we look at volatility, the VIX close back above 30. I was telling our members in the chat room, I'd like to see the VIX close under 30 going into the weekend, but no such luck, right? So if you look at this, let's just get this over here like this. We'll switch them out, move them out. So we're still in a very elevated volatility market, right? Extremely elevated. So for options players, it gives us a lot of opportunity. We're in the red here in the markets in correction territory. I want to see us get back down at least into the mid 20s, but I don't see that happening. I think we're going to stay elevated leading up to the Fed meeting this Wednesday, and then we're going to see where we go. I think if they do nothing but raise the rates 25 basis points and say they're going to take it one meeting at a time and don't commit to anything, then I think it could have the opposite effect and move the markets a little bit higher. But we'll see. I mean, we'll see how that works. Right? We'll see what happens. So not really sure how everything else will play out, but that's kind of what we're going to look for. Okay. Now, if we come down here and we look at treasuries in the bond market, any rally in the bonds, hear me out now. Any rally in the bonds, sell the rally. That's what you want to do. Sell that rally. We hit a low down here, right? On February 16th. Here's the rally. Boom, sell it off. So if we do get that pullback that I'm looking at over the next 4 to 6 weeks, bonds are going to stay here. They may even move up a little bit. Sell into it. That's what we're going to be working on with our members. All right. We got a couple of different ways we can make that trade. US dollar, same thing, right? Dollar is strong in global times of weakness. You can see the dollar just does not want to move higher. I mean, lower right now. It's staying up here because of the war effort with Ukraine, right? So when you've got that going on, you just got very difficult for the dollar to move lower, right? And you can see here that that's the high for the year 2022 high right there with the US dollar. Okay. If we come down here and we look at metals, gold naturally, it has had a strong run. I think gold is going to consolidate up here. If they have a negotiated settlement, gold is going to come down very hard. It's probably going to move back through the 1900 and bottom out somewhere down in this area down here. Then I think it'll start a long, slow ride back up. But for those of you that made money on this gold run here, start taking profits or create a no risk trade or a no lose trade or a guaranteed profit trade right there. And then you can sleep on a softer pillow at night and you can make the play. Be very careful of chasing gold up at this level, right? Just be careful in doing that. And then, of course, if we look at silver, silver's the same, right? And for our members, silver is our preferred play. By the way, it has a higher beta. You can see the move here, but silver tends to go with gold, but silver tends to have a higher beta. It moves faster than gold. So this is, I think it's going to go higher longer term, but I think it's going to work off some of the profit taken in excess and then work its way back up. Okay. Energy, well, we've got ways to play energy that allow us to make money. You can see this big move in energy here, this big move back. One of the trades that we had running, I was talking to our members about, is working out outstanding right now. And I do believe energy is going to kind of catch here a little bit. And then it's going to kind of drift. It's going to have a hard time moving up higher unless we get some more sanction driven markets. It depends on also on what OPEC does, right? OPEC could always produce more oil. We'll see what happens with the oil market. But we've got a play going on right now, a position structure that works out really well with oil trading in this range, and it's not a condor. You can get hurt if you're doing condors. Iron condors are a little bit better, but you got to do it as a spread. But we got another way of playing this that really works out really well for us. Okay, so that is the oil market. Nat gas, a little bit trickier, but you can see nat gas is going to have a hard time moving up here like this. Nat gas, as I always say, when it gets up into this blue area, after any run up, real fast run up, you want to sell it. Just be on the other side of the coin there. You can do really well in nat gas. Okay, so those are just two of our favorite trades. Then we got some things that we've looked at in wheat and corn just because of the run that we're seeing there. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday evening. We got some opportunities shaping up the way the markets are starting to look over the next 4 to 6 weeks. Have a great one, everybody. Put your clocks forward 1 hour, and members, I'll see you tomorrow evening on our weekly market watch. Take care, folks. Ciao now.